Good evening, everyone. It's now 8 p.m. and I will be starting my webinar. It is now the 22nd of August 2016, and your presenter is JOHNA. Hello, I am a Forex trader for some time now, and this is the first time that I am really in depth into trading when I entered Ashok Trading Academy, and it is something that I am very grateful for. We learn a lot from the community and from the academy, and this is one way that we can pass the knowledge forward. Okay, so my presentation for tonight is called What is the Fed and the Impact of its Rate Hike? Okay, so you guys can put your question if you have anytime, and let's start. So first of all, we do the risk warning, the caveat. Please be reminded that this is a high risk and please note that Forex and other leverage trading involves significant risk of loss. It is not suitable for all investors, and you should make sure you understand the risk involved. It is recommended that you seek an independent advice if necessary. Okay, any questions about this? Okay, let's start. So, what is the Fed and what is the impact of Fed on when they have a rate hike? Starting off, the Fed. The Fed is the Federal Reserve System. It is also known as the Federal Reserve or simply the Fed. It is the central banking system of the United States. So, how did this banking system start? Let's try to know the history first of the Fed so that we will know what they are doing and what is the impact of their actions to the market. So, the history of the Fed goes back to 1907. In 1907, there is what we call the bankers' panic or the Knickerbocker crisis, or just the panic of 1907. As you can see from the picture, this is the Wall Street during that time when everyone was having the economy was on a meltdown. So what happened? This panic of 1907 is when the US financial crisis that took place over a 3-week period starting in mid-October when the New York Stock Exchange fell almost 50% from its peak the previous year. The collapse of the Knickerbocker spread fear throughout the city's trusts as regional banks withdrew reserves from the New York City banks. Panic extended across the nation as vast numbers of people withdrew deposits from their regional banks. Okay, so this panic of 1907 may even have deepened if not for the intervention of one financier. And who is that financier who saved the economy, as they say? So, financier J.P. Morgan. J.P. Morgan pledged large sums of his own money and convinced the other New York bankers to do the same to shore up the banking system. So basically, J.P. Morgan intervened because then there were no central banks, only rich people, industrial tycoons, and J.P. Morgan is one of the famous bankers of New York. Okay, so after J.P. Morgan intervened, we could say that maybe the crisis abated. But at that time, it was only replaced by a further crisis. This was due to the heavy borrowing of a large brokerage firm that used the stock of Tennessee Coal, Iron, and Railroad Company. Okay, they borrowed a lot and they made the company a collateral. Ultimately, the company was about to collapse. So, to prevent the collapse of TCL stock price, it was taken over. There was an emergency takeover again by the Morgans through the JP Morgan, the Morgan's US Steel Corporation. And this move of a takeover was approved by an anti-monopolist president, Theodore Roosevelt. Okay, so as we can see during those times when there were financial crises, there were no central banks, only rich people, and they agree amongst themselves if they will intervene or help out. So for the next year, in 1908, a crisis investigation was done. It was spearheaded by Senator Nelson Aldrich. Aldrich, incidentally, is also the father-in-law of a rich tycoon during that time. He was John D. Rockefeller. So John D. Rockefeller's father-in-law started an investigation on how and why and what happened during the crisis and what could be done. This eventually led to the creation of the Federal Reserve System. Now, who is this guy? Okay, so this guy is a banker called Jacob Schiff of Kuhn, Loeb and Company. In 1907, he had a speech at the New York Chamber of Commerce, and his speech was a warning. He said, unless we have a central bank with adequate control of credit resources, this country, the US, is pertaining to, is going to undergo the most severe and far reaching money panic in history. Very fearful inducing words. But after that, investigations were done, and finally, on December 23, 1913, Congress passed the Federal Reserve Act, and it was immediately signed by President Woodrow Wilson. So after this was passed, the first chairman was Charles Hamlin. This is Charles Hamlin. And when the Fed, Federal Reserve Act, was put into law, they made 12 districts. So these 12 districts are all over the US, from San Francisco, from Kansas to Dallas, Minneapolis, and the most important of which is New York City, the New York Fed. This is the most important among all the Fed districts. And incidentally, the first president of the New York Fed is Morgan's deputy, who is called by the name of Benjamin Strong. Okay, so that is basically how the Fed got formed. It was because of panic, financial crisis, nothing, no central bank could inject liquidity when people are taking out money from the banks, and consequently producing more crises. Okay, so let's go to the Fed functions. What is the function of the Fed? The primary function of the Fed, why it was founded, is to address banking panics, as we can see from its history. Also, it is the lender of last resort for the US. That's why it's called the central bank. It is the lender of last resort, the last bank, the central bank. Also, since it is the lender of last resort, it regulates other banking institutions, hereby protecting consumer credit rights. Also, they manage the nation's money supplies to prevent panic, to prevent another crisis. or to stop hyperinflation, thereby maintaining the stability of financial systems. Since the Fed also is a central bank, it provides financial services to depository institutions, the US government, and foreign official institutions. But all in all, basically, the Fed was established to strengthen the US in the world economy. Not other country, but the US. Strengthen the US. Okay, so how does the Fed do their job, do their function, do their purpose? They have this called a monetary policy. Their monetary policy, the objectives of monetary policy are first, of course, to maximize employment so that consumption, people can consume again, people can start continuing their daily lives in trading, um, buying their goods. Trading, I mean exchange of goods, and to stabilize the prices. As we all know, when there's a panic, there's a crisis, there's over there's imbalance between supply and demand, so they could do stabilize the price. And finally, they moderate the long-term interest rates. Okay, so that is the monetary policy objective of the Fed. So how do they do this? How do they implement this monetary policy? They have tools. The Fed have tools to implement this monetary policy. I'm going there now. So first tool is called the open market operations. Okay, so what is the open market operations? The Fed constantly buys and sells US government securities in the financial markets, which in turn influences the level of reserves in the banking system. These decisions also affect the volume and the price of credit, or interest rates. The term open market means that the Fed doesn't independently decide which security dealers it will do business with on a particular day. Rather, the choice emerges from an open market where the various primary security dealers compete. Open market operations are the most frequently employed tool of monetary policy. So yeah, interest rates. Basically, interest rates. The buying and selling of US government securities in the financial market by the Fed. That's the open market operations. Okay, so next one. Next tool is called the discount rate. Discount rate, this is the interest rate that banks pay on short-term loans from a Federal Reserve Bank. The discount rate is usually lower than the federal funds rate, although they are closely related. The discount rate is important because it is a visible announcement of change in the Fed's monetary policy, and it gives the rest of the market insight into the Fed's plan. Okay, so basically, discount rate is the interest rate banks pay for short-term loans. Now, what is the next tool of the Fed? This is called the reserve requirement. The Fed implement reserve requirement to the institutions or the bank. This is the amount of physical funds that depository institutions are required to hold in reserve against deposits in bank accounts. It determines how much money banks can create through loans and investment. This is set by the Board of Governors, and the reserve requirement is usually around 10%. 10%. This means that although a bank might hold 10 billion in deposits for all of its customers, the bank lends most of this money out and therefore doesn't have that 10 billion in coins or in bills within the bank. Excess reserves are therefore held either as vault cash or in accounts with the District Federal Reserve Bank. Therefore, the reserve requirement ensures that the depository institution maintain a minimum amount of physical funds in their reserve. So, yeah, physical funds. Reserve requirement, physical funds from bank institution, which is about 10%. Okay, so those are the tools for monetary policy used by the Fed. So where does rate hike go? Rate hike is in the open market operations. So how does this rate hike go? Who does it? That's when we will talk about the FOMC, the infamous FOMC members committee that we see in Forex Factory or in other news or publication. So let's continue. The FOMC, or the Federal Open Market Committee, they are the ones who set target for the rate, but they do not give the actual rate itself. It's just a target. And they use the open market operation, which is the most important tool used to manipulate monetary policy. So, most important tool, open market operation. How does the FOMC do that? They set target for this rate, but it's not the actual rate itself, it's just a target. Okay, so since we're talking about this rate hikes, let us see how many times the US had rate hikes through history. Okay, this is a chart of the historical rate changes in the US. It's the federal fund rate effective 1954 to 06 to 2014 to 05. Okay, so 1952, 1958, there was a rate hike and then another one increasing to as high on 1982, almost 19%. The hike to 19%. I'm not going to talk about this part because it's way, 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 way in the past. There were a lot of crises in those era, maybe including the infamous crises, maybe the tulip crisis or the South Sea bubble, the tulip mania, depression, the post-Napoleonic depression, maybe. Since it's the 19th century, yeah, 19th century. So I will just basically talk about the latest, this part. Because this one is still in the Depression, World War One, Wall Street crash, 1929, energy crisis. So I'll just talk about this side. Maybe it's also the side when we are already alive and we know what's happening. And the news was more prominent in those times. And we have the data to talk about. So let us see the rate hike. 2000. There was a rate hike in 2000. If we could all remember, 99 to 2000, there was the dot-com bubble. There was a crisis called the dot-com bubble. Everybody thought that they just need to put a website online and they could earn from it. I've even heard about people posting their web page. Posting their company, IPO companies in the stock exchange, but it's actually just an empty website. So yeah, there was a crash basically. It was hollow, it was a bubble, and it was a dot-com crash from 1999 to 2000. Next was around 2007, 2008, around this side, another rate hike. This was the global financial crisis, which we can remember. Infamous for this one are the subprime mortgage, subprime loans, the Lehman Brothers collapse, which is around this side. If you guys have seen the movie The Big Short, it's a good movie. Go and watch it so you can understand more what is subprime, what happened during the subprime. Basically, it's greed. People just went too greedy. So there was another collapse, the subprime crisis. So this the global financial crisis. Okay, so moving on. What does this have to do with the country? This rate changes. So we move on to the next chart. This is the rate hike cycle. Major structural changes in the US economy and financial system over the last 5 decades. And the credit of this chart goes to CNBC. The other one was Wikipedia, I think. You guys can just find it in Wikipedia. You can find the sources online, the charts online. Okay, so let's go to the part where we basically know about, where maybe there was television or news and we could research on. So, looking at the chart, the first one is the Fed funds rate. This part. The interest rate hike, interest rate hike, interest rate hike, interest rate hike, and its effect on the GDP for the US, of course, and its effect on the S&P 500. Okay, so let's start with this side, the 2009, 1999 dot-com bubble. So basically, the GDP, people were basically well-to-do during that time. The GDP was high, but after that, the dot-com bubble, you can see this trench or this fall in the GDP. From the heights, it fell down. In S&P 500, you can see from the heights it fell down. Maybe we can see this further if we check the Nasdaq, especially since it's a dot-com bubble, and the Nasdaq is a basket more on index basket on technology. Okay, so basically that's what happened. There was a crisis. The GDP was bad. S&P 500 was at the heights of the dot-com bubble, and then it started to dip. So next one is 2007, 2008, around this side. So this is the subprime. As we can see, there was a rate hike around this area. The GDP during that time before the subprime mortgage, if we can remember, there are this they approved ninja, NINGJA. These are the people who have no income, no job or asset. The subprime collapse happened because the bank approved loans for ninjas. Basically, they are unable to pay back the loan because they have no income, no job, nor asset, but they were buying a lot of properties. You guys can check out again the movie The Big Short, and you will see that there was really a crisis. It was a very big bubble waiting to burst. Ninjas were buying properties here and there, and their debts was just repackaged into derivatives or whatever product by the bank, and in the end, it all burst, and the subprime crisis occurred. So before, the people were able to buy a lot of things, and then the subprime GDP went down. For the S&P 500, it dipped as well. After the rate hike, it slowly went up. Okay, so let's go to the chart which we can relate more to. Let's go to the MT4 chart that we have. So this is the US 500. It's a daily chart. Okay, so the last time that a rate hike was done by the Fed was at around December 16, 15, 2015. December 16, 2016. It was around this side, midway of this partition. Okay, so the rate hike from on December 16, 2015 was from 0.25 to 0.50. As we can all remember from the previous chart, the rate target was just zero before that during the subprime. Okay, let's go back. You can see this. Federal funds rate was zero after the subprime crisis. They increased their rate first on December 16, 2008 from 0 to 0.25. But I don't have that data. I will be showing the data only of 2015. Last rate hike was December 16, 2015, and it was from 0.25 to 0.50. This part, around this part. So for the US 500, the index US 500, we can see that during this month of the rate hike, people were anticipating for the rate hike news here, rate hike news there. So the S&P 500, as we can see, started to dip. Afterwards, it rebounded, forming a W pattern. But after December, starting January of 2016, it started to plunge. So this is the rate hike part. It started to go up, but on New Year, it plunged. After that, after a few months, it started to recover, and now we are on this side. In fact, we just had a new highs this last week. We had new highs for the S&P 500 last week. Okay, so that is for the US 500 index. Now, let us go to the USD currency. What happened to the USD currency when rate hike occurred? And this excites all the Forex traders. Let's go. Okay, so I took the pair Euro USD, and this is a daily chart. Again, the last Fed hike was December 16, 2015, midway on this partition, this yellow box, this side. So December 16, around this side, support. After that, it went up. And then it slowly dipped, but all in all, it was an uptrend. For the Euro USD, it was going down and then it went up. So basically, let's summarize the impact of a Fed rate hike. What happens really when a rate hike occurs? First of all, the immediate effect is on banks. It's not really on the individuals yet, nor on the stocks. It is first felt by the banks because it becomes more expensive for banks to borrow money from the Fed. And since banks are business people, they will pass on their burden to the individuals. So, hence, these banks will increase in credit card rates, increase mortgage rate, and there will be consequently increases in expenses for individuals. So basically, goods will become more expensive for individuals. And since the buying power of people starts to lessen, the stock market's roller coaster ride could get even more bumpy because uh, expenses people's expenses are increasing. They need the credit card rates increase, the mortgage rate increase, so basically goods will increase. So now the stock market will also be affected, and they could have, sorry, excuse me, more volatility in the stock market. As you can see back on US 500 basket index, you can see it even dipped on January. This is the Fed rate hike. After the Fed rate hike, the US 500 dipped lower. Okay, but what about for the currency? The dollar, the US dollar, could actually gain versus the global currency when there is a rate hike. So the last Fed rate hike again was December 16 of last year. For this year, the rate hike hasn't been done yet, but on Thursday, we will be seeing the Fed Chairman Janet Yellen, and it would be very interesting what she will say, if it will be hawkish or dovish. So basically, that's what happens when a rate hike increases. It's more expensive for banks to borrow money, so the burden is passed to individuals, and expenses becomes bigger for individuals, so the stocks could also be affected, but not immediately. But then the dollar, since there is tightening of the dollar in the market, it could gain versus the global currency. So that is my report for the Fed and how the rate increase. And it will be really an interesting week this week because we will see Janet Yellen have a speech, and it might be a hawkish speech this time. Everyone's been awaiting this rate hike, if it's going to happen this week or not. So if there are any questions, you guys could email it to me, or you can check out ashopta.com every day. You can see our news, our trade calls. Okay, so that's it for me. Again, my name is JOHNA, and I was your presenter for tonight. Thank you for listening. See you again next time. Bye.